world, there is a 80-20 rule, which is basically that the top 75 positions in a mutual fund house account for roughly about 80% of their AUM. So our insight is that, like I said, mutual fund portfolios themselves generally very rarely have bad companies. But within the core of the fund house, which is the top 75 positions, the chance of getting bad companies reduces even more. And that is really the insight, that we want to operate the machine in a very high quality universe so that the chances of getting a very poor company's outcome is limited significantly. Secondly, every fund house wants to win. Every fund house wants to try and create alpha for its unit holders. So they put their highest conviction bets in their top 80% of AUM, which is their top 75 positions. So our starting point is basically we take the top 75 of Birla, the top 75 of Kotak, Axis, HDFC Mutual Fund, ICICI, Franklin, etc., etc. At least we need 15 mutual fund houses. Today we are looking at 32 fund houses, and we get the total set of these top 75 stocks. Many of them will be common stocks, some of them will be unique stocks. So in some sense, we are trying to cherry pick through the machine what are the best ideas of each of the fund houses. So today, if you were to look at it, this super set of stocks, which is in the top 75 of each of these fund houses, totals up to about 240 companies. There'll be about 80, 85 large cap companies. There'll be about 130, 135 mid cap companies, and there'll be about 20, 30 small cap companies. From this list, we'd want to avoid the small cap companies. So this is going to be a pure large and mid cap from the best that each of the fund houses have, which they are wanting to create the highest alpha. But more importantly, here they believe that the chances of going terribly wrong are even lesser, right? So that really is the starting point of this universe. Then we blend in a quality factor, which is basically we look at the last 5 year returns. If the returns are very high, we kind of avoid it. Similarly, if a return is very poor sometime in the last 5 years and then it starts coming up, we think that it is a stock which is best avoided. So we avoid the two outliers, stocks which have done very well and stocks which have done very poorly at some point in time in the last 5 years. So through this process of elimination, we remove about 10, 15 names. Then we look at the form of the stock in the last 6 months. Which is basically the momentum factor. Within this high quality, we send it to the machine. At any point of time, we don't want to buy the entire market. If we were buying the entire market, we would buy all the 200 companies. Here, we want to buy a portion or a niche portion of the market, which is roughly 20% of the market. So we are taking the highest 20% of what the last 6 months form is. Even here, we are not looking at just point to point returns. We are looking at consistent form in every day. How consistent they have been is what really we are focused on. Now, so far, whatever we have seen is all backward looking data, which is we are taking from the fact sheets, we are looking at last 5 years, we are looking at last 6 months, etc. Now we want to look at what the forward expectations of these companies are. More importantly, we want to avoid companies which are not seeing forward expectations going up. And these forward expectations come from various broking outfits like Motilal, Kotak, Morgan Stanley, CLSA, etc. They all publish data about various companies. So we want to avoid names which are only going up without any fundamental basis. So through this process, we get about 40 or 50 companies at any given point of time. While the names are given, now comes the important thing as to how do we weigh them? How do we give how much each weight? We start with an equal weighted, so which if means that if there are 40 companies, we give each of them 2.5% weight. To this 2.5% weight, we skew on the basis of volatility or longer term consistency. The more the consistency, or that means the lower the volatility, we give it a higher weight. The maximum weight is capped at 5%. Higher the volatility, which means lower the longer term consistency, we give it a lower weight. The lowest weight is 0.5%. So through this process, wherein we run the machine on a very high quality universe, we employ the factors. Like I said, we employ primarily the quality factor, the momentum factor, and we weigh them on low volatility. And we blend in future expectations through the sell side. We get a biasless, without any bias, a portfolio which is having the best odds or one of the better odds of having to perform in the subsequent few seasons. Now, how often do we do this entire process? Generally, we do it every 3 months. Okay, so we run the same exercise every 3 months, right? Now comes to the most important thing, which is at the end of 3 months, let's say we have got already one set of portfolio which we have been holding on. At the end of 3 months, we've got another set of portfolio. How do we blend both of them? Do we throw out all of these stocks, or do we have some other process? We have some other process, which is basically that from the new portfolio, okay, we are basically wanting 20% of the new portfolio, which means we always want some near-term form to come into the new team, right? From the existing set of stocks that we have, all we are saying is as long as they are performing similar to the median stock, which means if we break down our entire universe into Q1, Q2, Q3, Q4, Q5, if there are 200 companies, Q1 will be the top 40 companies, Q2 will be the next 40 companies, Q3 will be the next 40 companies, and Q4, Q5 will be the bottom 80 companies, right? As long as you are present in Q1, Q2, Q3, we think that you are still okay to hold on. The moment you go to Q4, Q5, we think that you are starting to drag the overall portfolio, and now it's time for you to get out. See, we all know that markets and stock prices and companies don't perform every 3 months. Different companies perform at different points of time. They get appreciated at different points of time. All we are saying is that we are more than happy to give you time as long as you don't start dragging the overall performance of the entire fund, which is when we start taking you out. See, this process that we are saying is not very different from say how do you create a World Cup team. So, for example, in the World Cup team, one can say that if there are 5,000 Ranji Trophy players, we want to pick from all of the 5,000 Ranji Trophy players through some signal, right? This brings in with it its own biases, what the selector thinks about it, etc. And that is what the traditional way of looking at it. What we are saying is we will look only into the teams which the IPL team members or the IPL teams have bought into. So rather than looking at all 5,000 players, each IPL team itself is wanting to buy a team from each of these 5,000 players, and they all want to win. We create a team of, say, whatever, each team is about 25 to 30 players. Within this team also, there will be certain set of players that play most number of matches, maybe 80% of matches. It is only those set of players that we are focused on, because that is what we think that the team believes has got the best winning combination for them. So we are primarily again looking at, which is why we are saying that we are, instead of looking at the entire universe of listed companies, we are primarily looking at what other mutual fund houses have bought, and which, more importantly, which is part of their top 75, which play 80% of the capital is deployed over there. So that is our first starting point. Then we are saying that in a typical IPL thing, we are saying your form in IPL is what determines whether you get a shot at being into the team or not, right? So your your form in IPL is also not about how many centuries you have made or how many wickets you have taken, but in every ball, in every match, how much you have contributed, which is what our consistency that we are looking at. We are wanting a more consistent return rather than just point to point return. So that is our key signal. Then we send, say, a team of whatever 30, 35 players or 40 players to a selection committee. The selection committee is like our sell side, which basically evaluates whether they are technically competent. If they don't think that there is any technical competence, just because you've scored the maximum number of runs, doesn't mean that you will automatically get in. But through this process, we may eliminate one, two, three players. Now coming to the point that, okay, both Rohit Sharma and Sanju Samson have had a reasonably good IPL season. Sanju Samson's form is, of course, very good in the last IPL season. But if you look at the long-term consistency of Rohit Sharma, is much better than the long-term consistency of Sanju Samson. Therefore, Rohit Sharma will have to play more number of balls, and therefore he will open the innings, while Sanju Samson will come down number one. So through this process, what we are basically saying is it's a merit-driven process by which who are performing in a very high quality universe is what we are wanting to continue to perform. In case they are not performing, this doesn't mean that India will not become 36 all out, or we will not see such cases. It doesn't obviously mean that every match we will win. That is never a strategy that is going to win in every match, but it improves the odds meaningfully. More importantly, when we don't win, we take a review of it if the rebalance doesn't work out. And through this process, wherein anyone that has contributed significantly to the underperformance is mercilessly thrown out, anyone that is at least performing similar to an average player in the overall ecosystem, in the overall 200 companies, we are more than happy to hold on. And therefore, through a reasonable merit, we try and churn the overall portfolios. Now, a typical quant driven strategy will see very high churn, which is basically at one point, if there are 40 stocks, the next 3 months you get another 40 stocks. They'll throw out all of the current 40 stocks and buy into the new 40 stocks. This typically results in a churn of 70-80% every rebalance. Here we are not wanting to believe that we need to constantly be shuffling portfolios entirely. All we are saying is, if you are hurting performance, that is when you want to be monitored and you want to be exited, which reduces our overall churn from 70-80% that other strategies have to about 25-30% in every rebalance. And therefore, we reduce the rebalance churn. We get a very high quality portfolio, which seems to have a better odd of success. Now, typically, any such process can be tested. This is broadly the test data over the course of the last 1 year. Of course, the returns have been very, very high. But more important thing is this table down. So if you look at median 60-day return, 60 days is basically 60 trading days. Generally, in quant, every day that the markets are open, we get some signal, right? So in a quarter, generally after Saturdays, Sundays, and some holidays, generally there are 60 trading days. In a year, generally there are 250 trading days. And therefore, that is why we have given these numbers. These are rolling returns, which means from 2012 to 2024, there may be, multiple such quarterly data points, which is called rolling returns, right? So there may be 2000 such quarterly data points. In those 2000 quarterly data points, the median return is at 6.46% compared to NSE 200 total return of 4.26, roughly about 2.26% higher. More importantly, the volatility of this signal is still similar or lower than what the market volatility is. Roughly, whenever NSE 200, which is our benchmark, goes up in a 60-day period, this has a strategy will outperform 65% of the time. There will still be time frames where it will not perform. Like I said, there is never a strategy which will win every match. But roughly compared to a strategy which wins maybe 50% of matches, here when the pitch is good, okay, when markets are up, we win 65% of the matches. When pitch is bad, when market is down, we still win 55% of the matches. And thus, both in a up and a down market, it is better than the 50%, which meaningfully improves. So if you look at it on a 3-month basis, from 2012 to 2024, 62% of the time there is positive alpha. But as you give more and more time, if you hold on for 3 years, 5 years, there is reasonable evidence to suggest that almost 94, 99% of the time there is alpha that investors can look at. At least this is what the data from 2012 to 2024 suggests, that more time that you give to the strategy, the better the odds of performance. And that is what results. I'm sure many of you may have looked at the recent Federer video, right, in which he actually says, so while he's won 80% of the games, that he's done, he's won only 54% of the points. Every second point you lose. And yet, if there is a process of discipline and consistency, of merit, you invariably get a absolutely great longer term track record, which is what we are also saying. So this is the point that we are saying, that this is entirely based on merit. This is entirely based on the past form, without human biases, and therefore it results in a long-term profile which adds to the unit holder. The more important thing for you to consider is that this portfolio will be very different from any other portfolio that you already have in your portfolios. Why is it so? See, out here, nowhere did I say that if benchmark has got, say, 30% banks, how much banks I will have. If there is no bank which is coming into form, we'll have 0% banks. So typically in an active fund, the larger stocks or the larger sectors, etc., fund managers typically have some amount of weight. They may be underweight that space, they may be overweight that space, but there is always some amount of exposure which is there. Here, if there is no signal, there is no exposure. So there is no half measure that, I should at least have so much weight, etc., even if there is no signal. Due to this, as well as the fact that our weighing is very different, it is basis low volatility, the portfolios end up looking very, very different. See, if you look at a typical large and mid cap category or a flexi cap or a large cap category, the top 10 names which are there would be names like, just the heavyweights. It will include Reliance, ICICI Bank, Infosys, Larsen, ITC, etc., right? Here, the top 10 names will be very different from any of these names, even though the names are coming from the same set of names which are there in every other portfolio. So it's not that we are going to get a completely unique name that is not part of any other portfolio. This is still going to have the same set of names, but it's just that it is weighted very differently. The real reason why it is working is not because what it is buying, but what it is selling and what it is avoiding. This is not a strategy where we will buy, say, a sector or a stock from its absolute bottom for us to say that, we bought this stock at the bottom and from there it generated. We are for sure going to miss the first 10, 20, 30% of such a move. But what we are saying is, while, for example, an HDFC Bank, and I'm just bringing it up because it's a great bank, a wonderful legacy of creating wealth, etc. Okay. Now, this is not a strategy which will buy HDFC Bank at 1300 and say that, we bought it at the absolute bottom, which is a great strategy. Again, there's nothing wrong with such a strategy. However, this is a strategy which says that the process of bottoming out for many of these names sometimes can be 3 months, sometimes can be 3 years, sometimes can be 10 years, through which the process of bottoming out happens, right? All we are saying is our strategy avoids that process of bottoming out. So therefore, in any strategy, there is some capital that gets allocated to this, saying that maybe now it will bottom out, maybe now it will bottom out. Here, there is no such thing, no capital being blocked, which doesn't mean that every part of the capital will perform. As I said, obviously, some of them will perform, some of them will not perform. But having that hope that, whether it will perform in the next 3 months, next 6 months is not a strategy out here, which is why you get a portfolio which is very, very different from the rest of the market. If you look at how, the market cap trends are, the green line is the large cap allocation. Roughly about 60-65% would be large cap, and the rest would be mid cap. Momentum as a strategy has worked very well from 2020. Okay, on the right hand side, basically are stocks which have been part of momentum portfolios more often than not. Out here, if you look at it, on the left hand side is our backtest portfolio, which are present more often than not. These are all names that you will find in any other mutual fund. Like I said, because we are basically selecting only high quality names from a mutual fund, the chance that you're going to get a very highly controversial name or a name that is not there in any other fund, when it performs, it can obviously give you very high returns, but when it doesn't perform, it can actually give you a lot of pain and very high BP. We don't want to give any BP to the clients, in the sense that we don't want them to question us what kind of a stock you are holding. We will never be holding a stock which is not there in any other core of any other fund house. That way, we are basically banking on the fact that all other mutual fund managers, including us, typically want to avoid bad companies, and therefore that these set of names will be very high quality names which are generally very liquid, wherein you would not have trouble getting in and getting out, nor will you have any doubt whether these names are good. So you will not have typically names where you can have question marks as to whether these are good companies or not. um, Lastly, the reasons for you to evaluate such a strategy would be very high active share. Like I said, most other active funds, if you look at it, will have an active share of 50, 55, 60%. Out here, the active share is 80, 90%. It's going to be very different from any other portfolio which you have in the large and mid cap category. Okay. Roughly very diversified portfolio. You'll have 40 to 50 stocks, no stock more than 5%. We generally rebalance every 3 months, sometimes 2 months, sometimes 6 months. We'll be fully invested. We will not be taking a call on the markets, etc. We'll be fully invested at all points of time. The real reason, like I keep saying, why this works is not about what we are buying, but what we are selling and what we are avoiding. That is where typically the biases of fund managers come in. Here, by having a clear rule, we kind of remove that biases. In short, this is the best of both worlds. Like I said, man plus machine is greater than man or machine. We are not trying to predict the future. We are not astrologers who know which stock will do well, which sector will do well. So when you look at this portfolio, that doesn't mean that this is our house view. Our house view is basis fundamental research, wherein we are trying to think in 3 years time frame what is likely to change, which stocks are likely to outperform, which sectors are likely to outperform, which teams are likely to outperform. Out here, we are basically banking on the past form persisting for some more time. That's about it. Like I again say, we will not take any cash calls. If there are 40 stocks in our portfolio and one of the stocks experiences an adverse development, maybe the promoter gets sent to jail, we will get out of that position and we will buy into Nifty. Okay. So unlike a typical passive factor or a pure quant, which will hold on to that stock, here by having that insight, it's like a turbulence, right? That is when the pilot takes control. Most of the times it's run by the machine, but sometimes the pilot takes control. Similarly, in case we see such development, then that is the only time we will act. No new IPO will come into this. For a company to come into it, it has to be listed for at least 1 year, and it has to be part of the top 75 of any one mutual fund house, and it has to show form in that. Right? No new name will come in. We are not taking a call on market on the basis of which market cap will do well, which sector will do well, etc. So this is basically a benchmark agnostic, bottom up, large and mid cap, merit driven kind of a fund, which has a reasonably high odds, especially if you hold for 3 to 5 years, to give you repeatable alpha as was shown in the evidence from 2012 to 2024. So I'll kind of stop here, and happy to take things forward the way Amit sees fit.
Sure. I think thanks, Harish, for this crisp thoughts. Quickly, we'll get into the question, and Mr. Prabhat Goel's first question I will pick up. I understand, Harish, you had set up similar fund at the Kotak. What was that, and what were the learnings of that you would like to implement over here?
Yeah, so you're right. About a year ago, we had started a similar kind of a framework. There are broadly two changes to that framework. One was when we launched there, we were very worried about how large a fund can the capacity be, because there were some names which were slightly illiquid over there. Here, therefore, we brought in this core 75 concept of every fund house. Like I said, in these core 75 stocks, there is so much of liquidity that already mutual fund managers have bought in, that the chance for us to not be getting liquidity gets reduced significantly down. So therefore, the capacity can be much, much, much larger than what it was in Kotak. The second thing was at Kotak, whenever we launched, and that also is continuing to be a great strategy. The constant feedback that we would get is all of this is backward-looking data. Where are we incorporating forward-looking data? So, which is why we have incorporated forward-looking data through sell-side estimates, and that's the forward-looking data that we have. Then there are some more churn reduction. Over that churn was close to about 150%. We brought that down to about 120%, etc. Right? So the broad architecture is similar, but we've added these two. So when I look at portfolios, currently there is almost a 70% overlap between their portfolios and ours. With time, it will diverge, right? And that is how. See, any quant strategy, you have to constantly keep adopting and evolving, basis market conditions and basis the broader framework. Because with larger and larger money going there, you need to constantly be blending fewer additions. So that is broadly what we have done in the last 1 year. Maybe over the course of time, we will add some more factors. We would want to blend in value at some point of time. Definitely, we want to further improve our model in terms of rebalancing. While we have a dynamic rebalancing, we think we need to further improve on that. We want to further bring churn down. So, but the basic core concepts of the fund will not change, which is that we are wanting a niche in the overall signal. Active share will always remain high. We will not want to buy the market. We are getting a signal which is different from the market, and therefore active share will always be 75, 80, 85% or higher. Right? We would always want to blend in momentum, low wall, and quality. Maybe we'll blend in other factors at some point of time. So that's broadly how our learnings have been, and our basis feedback we have incorporated out here.
Sure. The next one is from Mr. Ravi Shankar. Why can't this methodologies apply to all funds? Why only for this particular scheme?
Great question. So, like I said, first and foremost, this is a niche strategy. Like I said, we are not buying the market, we are buying a portion of the market, right? Which is different from the rest of the market. The second thing is, for example, in Birla, totally we are managing 1.5 lakh crores of directional equities. Okay. Now, these are strategies which have still very high churn at 100, 110%. It's not a low churn. Um, and which would mean that we would be buying and selling say 4,000 crores of a particular stock. Then just because the machine is saying now it is again performing, we are buying back. So therefore we will not be as ruthless as what the typical machine made frameworks will be, right? But the learning, as you rightly pointed out, the key learning of a quant strategy is what it seeks to sell. And that is the single biggest weakness of human fund managers or active managers. So we are actually incorporating the same signal that we have when it comes to selling or when it starts underperforming in our active strategies in the rest of our funds. Again, there, unlike a pure quant strategy where we will get out, okay, over there we have a slightly more defined review process where it gets into Q4, Q5, we go and meet the management, we try and understand what it is. Sometimes it could be a temporary thing, sometimes it could be a far bigger thing, and then we come and decide either of three things. We either double up, which means that there's a great price, we want to further increase our position, or we quit. We say that okay, we have made a mistake, let's move on, let's look at other things. Or we give a sunset time frame, which is basically sometimes what happens is the management may say that the plant that was going to come has got delayed by under 3 months. So then we give it say under 6 months to see whether we can continue to keep monitoring before exiting. But the key process that we need to be better at selling, we are already adopting to the broader all other funds. But the reality is that we will not be able to accomplish the complete ruthlessness of a pure quant fund. Like I said, a pure quant fund, a rule-based man and machine product, will always be a niche of the overall market. So if we are managing 25 lakh crores as an industry, maybe this will be say 3, 4, 5 lakh crores. It can never be a larger set of thing, because with more and more money is going into it, that itself will impact the overall performance. So therefore there's a role for quant, there is a role for actively managed schemes. Both of them are important, but we can take the learnings of each of them to get better, which is what we have done in. So while adopting quant, one could be that we could have looked at pure machines. It's not to say that they don't give you returns, but typically with these pure machine-based products, you get three side effects. The first side effect is BP, which is that you don't know what kind of names you are buying into. There will be names that you will not be very comfortable seeing in and saying that was what kind of a name is this fund manager buying. Out here, you will never see any bad name. Like I said, in the fund, because we are basically working on the other active fund managers' diligence, right? The second side effect of a pure machine-based strategy is very high churn. 500, 600, 700%. Now, when volumes are good in market, it may not be a problem, but there will be time frame when volumes dry up. At that point of time, very high churn will lead to massive slippages, massive impact cost, and that will start hurting performance meaningfully. Okay. The third side effect of a pure machine is the volatility. They give you high returns, but they come with very high volatility also. What we have tried to do is to blend it with the low volatility so that you get an experience not of a very high volatility that otherwise it brings in. So these are the learnings from our other active strategies, right? And so we have used those in terms of refining a pure machine to a man and machine. Similarly, we are using the insights of a pure quant in all our other strategies to get better at selling. And so, we will use the principles, but it can't be completely machine made in all our other strategies.
Sure. Thanks, Harish. Next one is, what is the protection in a downward market since manager intervention is limited and bound by the algorithm?
Yes. So in a downward market, the key benefit is this is diversified, right? So there will be at least 40 to 50 stocks. It's not a concentrated focused product where there are only 10, 20, 30 names, right? So that is the first level of diversification. The second level of diversification is generally we are weighing it on lower volatility. So therefore, the more consistent names or the names which are more or which have been less volatile typically tend to get weighted more than a stock which is higher volatile and therefore tends to get lower weights. But outside of that, if markets fall, can this predict what it will do, etc.? The answer is no. We'll also fall with the market, sometimes more, sometimes less. But generally, what we have seen is that in any 60-day period, when market falls, this tends to do better than the market about 55% of the time. That was the data that I was sharing. But will it fall with the market? Absolutely, yes. I mean, there is no hedge or something that we have in this product wherein we'll know exactly when to put in, etc. There are other products maybe at a later time which will blend both of them. But for now, it is primarily a fully 100% invested. But we've got some diversification benefits of a reasonably diversified portfolio, no stock more than 5%, and the weighting basis low volatility compared to just what is performing in the near term.
Sure. Thanks. The next one is, what's the basis for picking those 75 stocks? And do you reduce the weights of the stocks even if the volatility is on the upside?
So the basis is basically, like I said, the top 75 in a fund house account for 80% of AUM. Right now, these top 75 are generally stocks which are part in multiple funds within a fund house. This is what differentiates one fund house from the other, right? Uh, these are names which go through a very stringent review, because if any of these stocks underperform or provide you a very bad experience, it impacts the overall consistency of the fund house. And therefore, risk management committees, investment committees, the CIO, multiple fund managers, analysts, many people are involved in that decision making. So firstly, we think that the chances of us getting a very terrible outcome from one particular stock is relatively lesser. Again, it can never be avoided, but it is relatively lesser because of these oversight. The second thing is, within these 75 names, like I said, if I were to add all of these top 75 in each of the fund houses, today these are about 240 names. Within these 240 names, there is already 20 lakh crores invested into the by the Indian fund managers. So from 20 lakh crores, can I construct a portfolio wherein each stock is 100 crore, 200 crore, etc.? I don't think it is necessarily going to be a challenge, because it's already, somebody has already done and keeping it in their code, that we will not be having a challenge to buy or sell from within this code. That's the second key aspect. The third is, every fund house also wants to outperform, right? They are not doing it for charity. All of us want to outperform and delight our unit holders. Now, therefore, they place their highest conviction bets also in their top 75 positions. So therefore, a combination of all of these is where we focus on the top 75 as a percentage of each fund house. And then we look at varying fund houses. Some having a value bias, some having a growth bias, some having a quality bias, etc., so that we get the lens of the market from different lenses, right? And then we are looking at what is performing within that period. So that is why we are looking at the top 75.
Sure. So how, I mean, though you have answered, but still, how often do you rebalance the portfolio? Is it as and when a stock enters bottom two quartile or fixed intervals? And
Yes.
second one is benefits of investing during NFO period rather than investing in similar fund with the experience.
Sure. So yeah, this is not when it goes in Q4, Q5 in between. Okay. So this is at a static or at a common point, roughly every 3 months. Sometimes we do it in 2 months, sometimes we do it in 6 months. It's a dynamic rebalance, but broadly it is a fixed across the entire universe. So it is at that point that we check whether it is in Q4, Q5, and not at some time in between when something goes below Q4, Q5. So that is point number one. See the benefits of, quite honestly, a fund with a good track record can always be bought in much after the NFO. I don't think there is really any benefit, so to speak, to buy into an NFO. The only point is this is not really a new strategy. Like some of you may have noticed, there is a fund which is already there in Kotak, which I had launched, which had a similar strategy. So you can have a look at their portfolios, their returns over the course of the last year or so when it is performed, and you can take then a view saying obviously it's not going to be the same portfolio. 70-80% is going to be similar, but with time we'll keep blending in, just like we have blended these two factors now, which is the core 75 and the sell side revisions. With time we will continuously keep adding. So therefore the team that would launch there is now here, and so over a period of time you can take a call as to whether it makes sense. Outside of that, really, you can look at it now, you can look at it at a later time, whenever. I mean, this is an open-ended scheme, so you can come in at any point of time. So those standard rules apply here. See, unlike a traditional active fund manager where you don't know the process or the thinking behind, what we have kind of given you is 80-90% of how a stock will get in, how a stock will get out, what it is going to be weighted at. We have given you pretty much the entire rules right now. Therefore, if you keep following the same rules is what we have given you the back test by, and therefore you have some sense as to how it is done, and you can have a similar, I would say, you need to have a similar kind of a faith that this process will be followed over time. It doesn't mean that every rebalance will get you positive alpha. Like I keep saying, in the near term, there is maybe a 60% chance that this gives you alpha. But as you give it time, over 3 years, 5 years, is where the chances of getting alpha move up quite meaningfully.
Sure.
I think there are some questions, Harish, where people want to know what is active management of a fund. If you could just clarify once.
Out here, see, in this fund, there is an element of man also, which is basically that, like I said, if out of 40 stocks, one stock sees an adverse development, you can get out of that particular name, right? Secondly, this is an open-ended fund, okay? So let's say that I'm getting money 5 days before the next rebalance. I know what the next portfolio is going to look like, what the next rebalance date is, etc. Now, in a typical passive or in a typical quant strategy, all that money will be invested in the old signal, and 5 days later the new signal or the new portfolio will get reinvested. Here we'll just buy into Nifty, and at the end of fifth day we'll move into the entirely new portfolio. Thirdly, sometimes there can be some corporate actions that happen, right? Maybe there will be stocks which go up, say 60, 70, 80% within corporate development of a demerger, just because there is no delivery of that particular stock available in the market. And due to which we may decide that, okay, we can even look at such corporate actions to try and, try and take some benefit of. So and maybe, another one could be that the machine suggests 7 names from PSU to buy in a particular thing. We may think that we will be able to buy only or execute only 5 of them. Maybe one of them we will not be able to execute, in which case we'll buy, say, the PSU index instead of that. We want to be trying and aligning as close as to what the model is suggesting, but there may be, say, 2-5% difference from the model, and that 2-5% difference from the model, or when there is these adverse developments, etc., is what really the human intervention in execution. Of course, the real human intervention is, or the real human involvement is deciding how to blend in the next set of factors, how to blend in the next set of things. Because, like I said, here the signal has to constantly be innovated. We cannot be running on the same signal and expecting, that with more and more AUM running on the same signal, we'll keep getting, these returns. So therefore, we have to constantly, and over that, it is 100% human involvement, right? And so that's really the nature of the active human involvement.
Okay. What will be the strategy of the fund will follow if the market enters a bear phase and continue to slide for a considerable period of time?
So I think what I'll do is, I'll explain as to when this fund is likely to underperform. Okay, so that'll give you a broad insight. So there is never a strategy which will outperform at all points of time. I think by now everybody understands that, right? See, typically in a year where markets go up 10%, generally there is a trend within that, which sectors, which stocks are doing well, etc. Right? Those are years when the strategy will do reasonably well. In fact, it can be very, very high return depending on how strong certain trends are. And therefore, the form can continue to persist. And therefore, this really hits it out of the park more often than not. Similarly, if say the markets go down minus 10% and below, then also trends do come through. There are some at any point of time, there will always be certain sectors which are outperforming, underperforming, where money is getting attracted to, etc. When there's a clear trend of the market, you know how market participants will behave. And so again, there will not be a challenge the moment that trend gets established. The worst phase for a market for such a strategy is the whole year goes and markets are up 2% or 4%. Okay. Now, in such a year, basically, we are trying to find a trend every 2 months or 3 months, but there is no trend, right? And therefore, we are constantly changing the portfolios, incurring cost, etc., but there is no trend to it. Now, does this happen? Of course, it happens in markets. Every now and then it happens. Now, those are time frames where, we may be down -3, -4% compared to markets which are up 2% or 4%. And that is the pain period that this fund will experience. So generally what we see is that those phases come in at a period of dislocation, which is like, for example, 2013. A classic case of dislocation was India was part of the fragile five. There was taper tantrum, worries, and all that. And then Modi's election wave came through, wherein people were confused whether he'll come through and if he comes in, what will happen, etc. And therefore, market is in a flux, not knowing which side to be in. And therefore, the whole year possibly nothing happens. And then that'll be a year where we are constantly trying to change, but nothing comes over. Other recent year could be 2018, a year wherein after a very strong market wherein a lot of stocks did well, etc., we went to the complete reversal wherein you saw very few stocks doing very well, and those stocks which did very well were all the heavyweights. If you remember, the term that was called was the Hrithik stocks. Those 8-10 stocks did everything. Now here we will get into those Hrithik stocks, but the weight of those Hrithik stocks will still be maybe cumulatively 20% against 50%. Even if say a Reliance Industries comes in, we'll have maybe a 4% weight out here compared to the benchmark, which is at 8-9%. That will again be a year wherein, when only fewer stocks do well and it's the thing, this will kind of underperform. So generally, these periods come in between 6 months to 12 months broadly, right? In a span of 3 years, 5 years, we generally see 1 year like that, or maybe, in 3 years, 1 out of 3 years being there, and the rest of the 2-3 years, it kind of goes well. Which is why we say that, over a 3-5 year period, this typically tends to do better.
Sure. Thanks, Harish. And the last question is what is a beta on a rising market and in a falling market based on back testing?
Okay, see, I think, beta, okay, the real answer, of course, is I think on a rising market, we tend to have a higher beta. On a falling market, like I said, see, what is falling market again depends on how sharp the fall is and how long that fall is. If it's a sharp fall and a long fall, generally the beta is much, much lower, because the fund will in each case move into defensive names, may not be in the first rebalance, by the second and third rebalance, friend. Okay, and maybe I'm not answering the question in the way that they want to hear, but roughly if I were to regress this against the market, like I said, we are not wanting to buy the market, we are buying a niche within the market. If I regress these returns on a daily basis against the academic 5 factors. Okay, roughly about 65% of the returns is coming from the market, 15% is coming from the momentum factor, 15% is coming from the quality factor, right? Typically, in any other fund, you would see 95% coming from the market factor and the rest being very little. So this will be a product, from in an up market, generally you can say that the beta will be, say, maybe 1.2%. In a down market, I would say it would be close to about 1.05. This is what the numbers are. But it is also a function of how big, how long the bear market. If it's a shallow bear market, then maybe this will fall more. If it is only a 3-month bear market, this will fall more because you will be loaded up in cyclical names which will not be able to provide. So it's also a function of how those bear markets have been.
Sure. Thanks, Harish, for all your thoughts and the clarification. One question I want to ask to Kamayani. Kamayani, last 1 month, I mean, it's completely your Bharat Brahman Yatra. You are catching up with all the investors, advisors. What's the fear on the ground? How people are perceiving this?
Well, there are two ways of answering this question. One is that because it's a very differential strategy and it is something which has I would say quantitative analysis involved in it. I think the interest on the ground is fairly high. But however, I would be incorrect if I would say that, of course, looking at the current market and looking at the way, like some people have also said that it's clearly a rising market. There is also some skepticism on whether this is the right time or no. But I would just say one thing which I have told all my investors in the past 25 years that I have been in this industry. Rather than timing the market, time in the market is what is super critical. So it is not about when we try to time it, but how long you stay invested and get the maximum returns. I think that is what I would put forward to you, Amit.
Yes, thank you. Thanks, Kamani. I think that's a very good mantra to be in the market. Don't get into the timing to the market. So thank you so much, Kamani, Harish, and everyone. Based on your feedback, as this has to be very crisp, and we are keeping this, we are ending it on a time. I have messaged my email ID into the chat box. If any of your questions which are being unanswered, please feel free to mark me an email. Personally, I will ensure you will get all the answers of the questions which are being unanswered.
I also have a suggestion. I think you'll get a dump of the questions from the host ID.
Okay.
So you can then answer those questions one to one, whatever has not been answered on the chat. I did try to put in as many answers as I could on the chat and the Q&A. But if some questions still remain unanswered, you can take a dump from the host ID, Amit, and answer those questions as
well. Sure. Okay. Thank you so much, everyone. Thanks.
Thank you. Thanks for being here. Thank you.
Thank you. Thanks.